Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for March 1st of 2026. Well, certainly, without a doubt, the biggest headline over the weekend was the bombing of Iran, joint effort between the Israelis and the United States militaries. First thing we should obviously look at as I prepare this presentation, before I know how the market's going to open, I suspect there's going to be quite a bit of volatility tomorrow, particularly within the energy space. And on this chart, we take a look at oil prices since 1920, provided to us through Bank of America Global Investment Strategy. You can see that here, dating back to the OPEC oil embargo in 1973. Since that time, we've seen a tremendous amount of volatility in our energy markets, and in this case, oil in particular. We look at Russia, Ukraine, 2022. We saw something approaching $120 a barrel, just in a very brief spike. As on the other side of the equation, we had COVID in 2020 with demand dropping through the floor, with the economy being shut down. And we sit here in kind of the middle part of that here in February 2026. And we do know that oil prices have been a little weaker. And we've seen that crude oil stocks have been fairly low, so there's not a lot of cushion here. Certainly some talk over the weekend about OPEC trying to increase its capacity. OPEC Plus is going to meet. That would also include Russia, by the way. But unfortunately, there's not a tremendous amount of spare capacity that would either offset Iran or perhaps offset some of the shipments from the other areas which pass through the Gulf of Oman and through the Hormuz Strait, which right now is an issue just because a lot of the carriers of the crude actually don't have the insurance to cover it. Now they'll run the oil through the strait, and it's not like Iran can just simply close the strait. Obviously, they can try to militarily enforce ships to not pass through, but they can't literally close it. But the bigger issue, as I've been reading, is that a lot of these tankers and carriers, need the additional coverage to give them the comfort to be able to try to pass through the straits. But anyway, you see here, oil can be volatile, and I think we should certainly expect that here in the first part of this coming week. Here we have daily exports from Carg Island. You can see that essentially Iran was expecting what hit them this weekend, and they had accelerated some of the shipments from their key ports. You can see Saudi crude exports. Again, this has been fairly well telegraphed that this was a risk, and I think if it's one thing that we've all learned is not to underestimate President Trump when he says that he's tempted to do something. In this case, he certainly did it, and we won't argue either the merits nor the procedure or anything like that. We're just saying that the fact that it happened here, we've got increased exports coming out of Iran, trying to get those tankers out to sea before any disruption happens. And then you've got major OPEC members that are ramping their production ahead of any unforeseen hostilities. Here we have commodities versus gold. Gold being viewed as a safe haven asset. There's obviously gold, as we've seen very well over the last few months, as an increasing source of reserves versus U.S. Treasuries by a lot of foreign central banks. And you can see very clearly here the spike in gold, which typically had a fairly tight correlation to the equal weighted commodity index. You could see a definitive break here over the last year, and a break that is basically unprecedented. This time series goes back to 1995, but this break, I can't even begin to say right now, necessarily how it gets reconciled. Now, I do know that, given the status of the dollar and depending on where that goes, that you could very well see the commodity super cycle kind of reassert itself, in which case you'd have commodities move higher. But I definitely think gold, from a technical standpoint, has gotten ahead of itself. Now we're going to switch to some data that we got from the past week. This is producer prices year over year. Producer prices, at least for the month, were up 0.5%. That was above the consensus estimate of 0.3% and up from 0.4% in December. On a year over year basis, producer prices were up 2.9%, and that was versus 3% in December. But on the downside, it was about 0.3% on an annualized basis higher than what was expected. We had food and energy both were down during the observation period here, and so core prices were up 0.8% for the month, and year over year they were up 3.6% versus the 3.5% estimate. And so, as you can see here, crude prices running a little bit hotter than the Fed's 2% target. That's been the case for quite some time. It's really kind of almost prompting the rhetorical question: is the Fed's target just simply too low? And I think there's probably some validity to that. Here we have a chart from Charlie Bolello, Creative Planning, and I always love to look at this current situation relative to history, and we have had quite a few economic expansions dating back to the post-World War II period. You can see here in the blue shaded area that the current expansion is from the post-pandemic period when the economy reopened through at least last December. So we've got 68 months and counting. Cumulative real GDP growth, this is just the total increase, has been 26% during those 68 months, making for an annualized real GDP gain of 4.2%. And so the prior longest, and is actually on record as the longest expansion, was the long one that we had over the last decade leading up to the pandemic. And of course, that was basically over 10 years here. And you can see that the average annualized GDP growth was only 2.4%. So it was a time where, on balance, markets were relatively good. Returns were, I wouldn't say predictable, but the model of diversification, the traditional 60-40 model, worked just fine during this period, even at a lower overall GDP growth rate. So this is, one part of that conundrum when we look at 4.2. And of course, you can look at the average over all of these different expansions. That the average expansion is about 67 months. So we're very close to that right now. And the annualized real GDP growth has been about 3.9%. So we're actually very close to that. But to some, this feels very much like a 4% plus economic growth, and to some people it feels very much not like this. And so I just think it's interesting to always keep the historical perspective in the backs of our minds. Here we have a chart republished by Charles Schwab. Here we have real GDP growth that we were just looking at in this kind of this amber line here, and then you've got in the blue line, you've got non-farm payrolls. And so, there being a reasonable correlation between the two. It was noted in some recent research, and I think it's worthy of mentioning that even though, the correlations, I wouldn't say break down, but they become a little looser at points in time. But, here we had an interesting inflection point. And then really over the last 2 years, we've seen real GDP track higher than the weakness that we've seen in payrolls. Obviously, with these shaded areas being recessions, you can see that typically when you have non-farm payrolls roll over to a reasonable magnitude, that you get recession periods. And of course, that's not necessarily in the cards, but again, I think with the events of the weekend, and how that translates into the energy markets and whether this turns into a bit of a regional conflagration, I just, don't know. Generally, geopolitical events don't result in meaningful equity market dislocations over time, but if the current circumstances lead to some kind of economic disruption where maybe a economic downturn is a result of something else, a related tangent to the geopolitical stuff, then obviously that could be something that we want to watch. But here we've got payrolls going down, we've got GDP remaining relatively sticky. Quick comment on tariffs, which we talked a lot about last week. Here we've got the trajectory of the average tariff rate. This is from a UBS research report. And then you see here, we had the tariffs struck down by the Supreme Court. This is basically the IEEPA tariffs. And then those are being replaced by these at least a 10% Section 122 tariffs, which have a duration of essentially 100 days. So we'll have to see where that goes. But you can see that average tariff rate kind of settling in here at roughly about 12.5%, 13% for the most part. Over here, we've got Oxford Economics. It shows the new tariff regime at that kind of that new global 10% tariff, really benefiting the rest of the world. And there's really, kind of an interesting way of looking at it, because obviously we're paying a lot of it. And I think the cost to particular states that have import-export, very high import-export operations like California and Texas have really taken it on the chin in terms of the cost of these tariffs being borne by importers in those particular states disproportionately. But you can see here, world global economic growth is it seems to be more positively situated rather than the U.S. Economic marketplace. Here we have contribution to economic growth from AI. You can see how that trend line seems to be moving in the right direction. Here we've got contribution from information processing equipment, and that green line expanding. So this is not unlike kind of what we saw with the expansion of the internet probably 25, 30 years ago. And you can see contribution from the rest of the components, and then upper income consumption, and then from software. Here you can see software, at least for the last few quarters, have been relatively stable, but it's the AI side of the coin that's really driving some productivity gains right now. Here we have AI, really employment and industries that are impacted by that. So we're getting some data that that might be helpful when you look at that last leg down. But obviously AI has been with us for a few years now, but really beginning to get integrated in core business processes. So, there's been a lot of other things that have been driving, employment lower in some of these areas that, you would commonly associate with having been, having some impact from AI. But again, it's not terribly conclusive right now how much employment dislocation is a direct result of AI. But obviously, I think the impact will become greater in the years ahead. Medical goods and services, inflation has certainly increased at a higher rate than the headline CPI. I mean, this is something that, we look at aging populations, we look at parenting aging parents, all of this related to what we do in financial planning to kind of predict the future. It makes it a little harder because this rate of inflation is relatively high. Here we have some grocery prices. I haven't seen this kind of depiction in a while, but as I've been talking to you, the grocery bill has certainly gone up, and this is a very good representation of what's going on here. I mean, to say eggs have had probably the most tumultuous journey, but there have been some issues related to bird flu and some other things that have caused the price of eggs to gyrate as they have. But you can see beef, coffee prices, up considerably. You even go to bread, and then the rice and the pastas and the starches. All of that's gone up as well. And so really everything's been touched. So that grocery bill is meaningfully higher than it was even just, call it 2 years ago. And this is what a lot of the people in the lower income cohorts are feeling. Here we have the Kansas City Fed composite index positive, not greatly positive, but indeed it is in an expansion territory after quite a few marking periods here of being negative. And then over here we've got new orders, both current orders and future orders trending in the positive. And so I view this as good, at least for the Kansas City Fed District. Here we have CEO confidence that's measured by the conference board. This is very interesting because, this does, as you can very well see here, kind of jockey around a bit. It tends to, go down either just before or while you're in recession. So not terribly surprising there. We did see kind of a false negative down here and down here, but CEO confidence is certainly higher than it has been in a little while. New business formation rapidly expanding. We're getting a lot of mixed signals, in this area. So we just looked at positive CEO confidence levels. We look at new business applications. Now, a lot of these are very, very small businesses, so let's not get too carried away. But in any case, you see a lot of business formation generally during economic expansions, which is what we have. So here we have mortgage market, some relief for buyers. Actually, this is about I'd say we dipped briefly below 6% at one point. So this is a couple of days old, basically on the 25th here. But you can see mortgage rates trending down. You can see the effective rate on mortgages outstanding, which we looked at a few weeks ago, gradually moving higher as more of the older mortgages are retired or refinanced and replaced with higher interest mortgages, even though that rate is coming down. Median days on the market seems to be moving up a little bit. This is a very, I'd say, relatively unhealthy market here because you had home prices moving up. You had basically a very unhealthy market, I would put it. We are getting in a little bit better shape, talking to at least some local and regional agents here, that the market seems to be settling in a little bit, but I know the new home construction market is still very, very weak. Apartments, the rents are going down. This is national. So again, some areas like the Southwest here, Texas, some of the major markets in Texas are weaker than this national average. But you can see the auger line here from that firm is a little bit more smoothed. But again, the trend continues to be down. Here we have capital spending. We've talked a lot about this. This has provided a fair amount of speculation in the markets so far this year. Whereas as I've been describing over the last week to clients, this time last year, this was viewed as a positive, that you're going to have tremendous rates of growth in spending. Now, of course, the law of large numbers kicks in, so these percentage gains do go down, even though the dollar amounts are pretty eye-popping here. But when you look at all of these companies in the Mag 7, the commonly known as the hyperscalers, What's going on now is these numbers are viewed with increasing skepticism, either from the standpoint of, you know, um, can this be achieved, and what is it actually going to accomplish, and how long is it going to take? And all these questions are out there, outstanding right now. Here we have free cash flow yield. These are the mega cap hyperscalers. You can see that free cash flow yield is moving lower. You can see the rest of the S&P 500 free cash moving a little bit lower, but still remaining relatively high. And then you've got over here on this side, we've got productivity growth. This is from BCA Research, and I just love how they're taking raw data and making some pretty interesting interpretations from it. But basically, they're just saying that there are times where you have operating margins moving higher, but you're not necessarily getting it from productivity growth, and so one does not necessarily equal the other. And I think that's I mean, it's a fair point, and that there are obviously other things at bay when you're looking at expansion in operating margins. Global debt, as we're looking at, is moving, continues to move higher. We're about 320 something trillion dollars in global debt, and I guess in a good sense, that as a percent of economic activity or economic growth or GDP, it is moving lower than that. I'd say that's the key takeaway to a world that seems to be adding more and more debt. Job postings for software, for AI, is obviously outpacing the rest of the market. So obviously, with that, you'd have a much weaker labor market if you didn't have the strength in the software subsection of that. And while we're monitoring labor trends, I think it's also helpful to look at the displacement factor. How many jobs have been lost because of AI? And right now, the best guess that we can come up with from Challenger Gray here is that only about 5% of announced job cuts were tied to that. Now we'll get into some investment market dynamics as we're looking at the various markets across the globe here, at least year to date. We've got about 2 months worth of data now. S&P 500, you can see that we've actually had some multiple contractions. So valuations have actually detracted from overall performance, which is something I actually expected coming into the year, because this was a big driver of equity market growth over the last couple of years. In a positive sense, we have earnings growth that have contributed to growth in overall U.S. equities for the year. Global is being helped both by multiple expansion. So we've seen more multiple expansion and valuation growth in the international markets than we certainly have seen here in the States. And then, Japan in particular has had tremendous multiple expansion with some of the political and political economy developments over in Japan. The European monetary unit growth as well. Emerging markets in particular have had really strong earnings growth, and China looks a little bit more like the U.S. in the sense that it really hasn't had much growth at all this year, and a lot of that's because this valuation component is detracting from that earnings growth in China. Looking over here, another very, very interesting development, the valuations in the technology sector, and particularly the Mag 7. We know that we've seen those come down quite a bit, and at the same time, very interestingly, Staples, which is kind of viewed as, these are relatively strong cash flow companies, but and somewhat economically resistant, and obviously not being viewed in the same light as these hyper growth companies are, but yet these multiples are about the same now. We've got consumer confidence in the one side. We've looked at this recently. We've got present situation moving down. We've got the overall number here. We've got expectations just kind of like stuck in a general channel over like a multi-year basis, and with particular maybe downward emphasis more recently. However, on the other side of the coin here, we've got stock price expectations that have decidedly moved higher. So there's definitely a disconnect. So you have kind of the folks that own stock the folks that own stock are optimistic, and the people who don't own stock are not as optimistic. Here we have financial assets as a share of total assets. This is probably skewed to the upper income cohorts, but I think it's important to look at this nonetheless, that ever since we've had the housing bubble and the global financial crisis here, that we've had those financial assets as a share of total assets move consistently higher. Equity market trading volumes have picked up as well. This takes us back to July of 2019, and you can see that there's really in the doldrums of 2022, when we had a pretty weak market, and then October was kind of the marking point of where that bottomed out, and then ever since then, equity market volumes have really taken off, and in fact, as the headline suggests, they've doubled in just the last few years. Here we have maybe a signal of some volatility. Looking at the markets, we've got the percent of constituents that have had a single day move of more than 10%. And just, really in the year to date here, we've seen a kind of an unusual spike. Now, again, November, August are representative months where, we've also had some of those movements, but, these can be a little disconcerting because they add a little bit of volatility to the market, but you can see in a lot of these months where we didn't have volatility that we didn't have these large moves, these large headline moves of companies that that in some cases may have pretty high market cap and may be quite influential in overall market volatility. But we've had some technology firms which, again, talking about the capital spending stuff, which has come under scrutiny, as I was talking about. We've got some of these things that are going on that's causing a little bit more volatility in our markets. We got the U.S. 10-year Treasury plotted against the commodity index, and again, we've got gold embedded in this. So let's be clear about that. That's been influential. Now, say the relationship here, like until you get to roughly about this point, has been positive, but I wouldn't say it's a really tight correlation. But something like this deviation does catch your eye because it is very unusual to have this kind of deviation. Again, some of this is gold, which we talked about, is already diverging itself from the commodity basket period. But at the same time, you've got yields moving lower, and you would expect yields to move higher as you get your commodity index to move higher. Now we'll take a look at kind of investor sentiment, and as you would not be surprised, and as we have frankly been talking about for a number of weeks now, that you've got sentiment which is kind of rolling over from both the institutional side, both on a current basis and that 4-week moving average here, and then you've got individual investor sentiment, which is kind of reversing itself now. You've got the bearish folks that are increasing in prominence, and the bullish folks which are decreasing in prominence. And so after a period of really strong bullishness, we're having a bit of weakness in that investor sentiment coming from the individual investor side of things. Now, on the flip side here, again, there's always two sides to a coin, and as we look at all the positive things versus the negative things, and here's something that would indicate that there's really no stress on the near-term horizon. This is the high yield distress index, and it's very, very low. I mean, we see this priced into a lot of the high yield market. Now, that has changed a little bit because some of these hyperscalers are now being viewed as, kind of potentially problem credits, which would have been astounding to have thought of that a year ago. But overall, markets are very complacent. This is not in any way indicating, any kind of particular stress in defaults or in non-performing assets. Very indicative of what you would see in a pretty strong growing economy. Thought this was interesting. So, this tells you why, in some respects, why you have some deviation between, overall consumer sentiment and investor sentiment. And you've got, the top 20% here make up almost 90% of all corporate equity and mutual fund ownership. And you look at these different, call them, not quite deciles, but in any case, the upper income cohorts, own much more of the assets, and because they move up, and they have been moving up, then it tends to make them a little bit more optimistic than it does the other people down here that don't own as much of those equities. Something I thought was really interesting as we kind of like talk about the evolution of our society is like the number of farms. We've obviously had a lot of flight to the cities from people that lived out in the country. We know that the number of farms in the U.S. has gone down rather consistently for a number of years, only remaining flat like kind of after the pandemic. We see, Texas, our home state here, has witnessed quite a few farms going away. Now, that's not to say that, that the arable land is in rapid decline, as this chart might otherwise indicate. It just means that, like, the number of farms, and of course, some of these are being acquired, and so you're having bigger farms and bigger farms, where you just have fewer of them. That's all we have for the chart pack this week. Hope you've enjoyed it. Have a great day and a great week, and we'll talk to you again soon.